In the rapidly evolving telecommunication industries, companies like AT&T and T-Mobile have played a pivotal role. My name is Ipsita, and on behalf of the team Perfectly Balanced, I present to you an accounting comparison of these two industry leaders. Now, AT&T is a relatively older player that came into existence in 1987, while T-Mobile came into 1994. We took a quick comparison of the various industry players and understood that at present, the highest top three market shares are split between AT&T, followed by Verizon, and then, of course, T-Mobile. Now, some of the important economic events that have held of significance are that AT&T went and purchased DirecTV, eventually also purchasing Warner Brothers and merging with Discovery Inc. On the other hand, T-Mobile very strategically went and purchased other telecom companies like Sprint and, of course, Mint. On the right side is a comparison that we curated after conducting interviews with employees who are currently working for the two companies to highlight what, according to them, are important factors behind the culture of their workplace. Now, moving into the financial analysis, we took a deep dive into understanding what do our Wall Street Journal analysts talk about, and the trends are very promising. Most of these analysts, as you can see, have suggested to buy the stocks of T-Mobile in comparison to that of AT&T. The numbers are distinctly different. Looking at the per share rating factors here, as you can see, this gives a view into the future, and 2023, 24, and 25 look very promising for T-Mobile with a consistent increase, whereas for AT&T, it is more or less on the same lines. And coming to the forecast here, as you can very clearly see that 26 analysts for T-Mobile have given a medium forecast of 175, and the range has been between 115 to 210 with a 26.6% increase. The numbers for AT&T haven't been this promising. Their median target has been 19 and the range has been from 9 to 25. What's very important to understand here is this gives us a view not just of the last 12 months, but also of the next 12 months. With that, I will now hand this over to my partner, Lokesh, to take this ahead.
Examining the 2020 to 2022 income trends from the 10K, AT&T faced a 21.2% drop in service revenues, offset by 20.6% growth in 5G equipment. Their overall financial landscape was punctuated by high costs, culminating in a negative net income of roughly $8.73 billion. T-Mobile, on the other hand, charted a positive course with strong postpaid growth and total revenues increasing by 16.3%. The company maintained a strategic focus on 5G expansion via its Sprint acquisition and profitability. While net income for T-Mobile decreased by about 15.5% during the same period, it is still notably positive, standing at $2.6 billion at the end of 2022. My colleague David will further unpack some key figures and findings through a vertical and horizontal analysis later on. As we transition to the balance sheet, we see AT&T's financial stress until 2022. Mirrored in the sharp 80.6% reduction in current assets and a 42.1% decrease in shareholders' equity from 2021 to 2022. T-Mobile, on the other hand, presented a more stable picture in comparison, demonstrating operational efficiency and a commitment to 5G infrastructure and balanced management. These historical takeaways depict AT&T's financial struggles, especially after the Warner Media spinoff, and T-Mobile's operational strength. In the risk analysis, both AT&T and T-Mobile share challenges in competition, technology, and regulation. The main takeaway is the continuous need for robust risk management and strategic adaptability in the telecom industry. Lastly, AT&T's diversification contrasts with T-Mobile's single operating segment, which is its wireless communication segment, emphasizing different business strategies. Common drivers include for both 5G expansion, customer growth, and innovation.
Thank you, Lokesh. Greetings to you, Professor. I will be taking up going through the slides on financial disclosures and their footing. So, starting with the financial disclosures, for AT&T and T-Mobile, no major changes have been recorded in the last 2 fiscal years. Disclosure controls are effective as of 31st December 2022 for both the companies. Internal control is effective for AT&T and attested by Ernst & Young, and no material changes for T-Mobile in the last quarter. Now going into the DEF 14 compensation structure for both the companies. So what is DEF 14? DEF 14 is a type of filing submitted to the US Securities Exchange Commission SEC by the publicly traded companies within US. So companies are known for the DEF 14 is also known for in companies as their proxy statement. Some other components include executive summary, agenda of the board meeting, board of directors, executive compensation, shareholders' proposals, ownership control, auditors' changes, etc. So right here is a DEF 14A table for AT&T, and right here is a DEF 14A table for T-Mobile, the most recent one for both of them. There are some footnotes which will be included in the appendix of this presentation. Now, some interesting findings based on their compensation tables that have been provided. So when you look at the CEO compensation, this is a comparison right here. For 2020, there was a major spike for CEO compensation in T-Mobile, which indicator of the merger of T-Mobile and Sprint. And then AT&T, on the other hand, has a steadier compensation with a slightly rising in 2021, which could possibly reflect the CEO's leadership during pivotal company changes that happened around COVID and other logistical issues, and with a minor drop in 2022 indicating lack of completion of specific incentives or milestones. Now looking into the EVP and CFO compensation comparison, pension is being provided by AT&T and not T-Mobile. Companies like AT&T, which have been existence for a longer period of time, have been offering pension. Newer companies like T-Mobile prefer not to offer pension, and they prefer 401k. So that is why there is a higher compensation being provided for AT&T compared to T-Mobile. But T-Mobile has a steadier increase in compensation year over year, which is in line with their growth strategy, which is aggressive growth strategy, while AT&T's steady rate indicates market stability and maturity. Now, looking into the compensation breakdown chart, this is also where you see that the stock awards form the major part of both their compensation for the companies. Salary for T-Mobile has a higher dollar value, but the percentage of which salary contributes of the total compensation is higher for AT&T at 9.7, whereas only 7.8 for T-Mobile. So non-equity incentives form other significant part of the compensation. From all this, we can conclude that T-Mobile's pay indicates aggressive growth, while AT&T indicates stability, which is an important finding. And now I pass on to Kalpesh for the rest of the presentation. Thank you.
Let's take a look at the Q2 2023 earnings for AT&T. The Q2 results are consistent with the guidance provided. Revenue growth was mainly driven by mobility service and consumer broadband. It has shown growing market share, low churn rate, customer growth, and improved margins. Wireless revenue has increased over the past quarters, and fiber business is also accelerating. They are on track for sustainable and profitable growth. Cost savings of $6 billion was driven by sunsetting legacy product portfolio and supporting infrastructure leads. This helped in the EBITDA margin improvements this quarter. They reduced the net debt by about $20 billion over the past 3 years. For the second half of 2023, AT&T expects free cash flow of about $11 billion. Factors driving the free cash flow are capital investment to be lower by $1 billion, device payments to be about $4.5 billion lower. They are on track to deliver the full year adjusted EBITDA to grow more than 3%. They expect net debt reduction of about $4 billion. Comparing the results with the previous quarter, Q2 revenue slightly declined by 0.66%, adjusted EBITDA grew by 4.7%, adjusted EPS grew by 5%, Cash from operations was higher at 48%, and free cash flow rose by 320%. Looking at Q2 earnings for T-Mobile, T-Mobile achieved a profitable growth up over 5% year over year. Revenue growth was driven by postpaid accounts and postpaid RPA. They did share buyback of 25.2 million shares for $3.5 billion. For the second half of 2023, T-Mobile expects postpaid customers to be between 5.6 to 5.9 million. Core adjusted EBITDA expectation to be between 28.9 and 29.2 billion. Expect capex to lower in Q3 and Q4, increase in free cash flow to $13.6 billion. Comparing the results with the previous quarter, Q2 revenues increased by 1.2%, adjusted EBITDA grew by 2.8%, adjusted EPS grew by 18%, cash from operations was higher at 7%, and free cash flow rose by 21%. Now comparing the quarterly result change between AT&T and T-Mobile, we can see T-Mobile has higher quarterly revenue growth than AT&T at 1.2% and a very strong adjusted earning per share of 18%, whereas AT&T shows higher adjusted EBITDA of 4.72% and a solid cash from operations at 48%.
Okay, I'm going to do a quick dive into the horizontal and vertical analyses of these two companies. AT&T's cash holdings have decreased from about 2.2% of assets to just 0.9% in 2022. That's the equivalent of about $8.4 billion. A quick look at the statement of cash flow shows that the number one reason for this is their net operating loss in the years 2022 and 2020. If those two are subtracted out, AT&T earned an average net cash from continuing operations of about $36 billion for all 3 years. Another reason for AT&T's net loss is the write-off of goodwill, again, related to the sale of DirecTV and Warner Brothers. And one outcome of AT&T's lack of cash on hand may be linked to an increase in their AP. It is nearly 75% of current liabilities and almost 11% of total liabilities. It indicates they may be slow paying. We'll see more about that in the ratios with Sri. Here we see the drop in income from the Warner Brothers operation, but also note their income from investing activities through Warner Brothers is increasing. At 1.7 billion, it is a fraction of the previous income of full ownership. However, it is all profit and growing every year. And again, we see the impact of impairment charges to net income in 2022 and 2020. T-Mobile has also been shedding cash, dropping from over 5% of assets in 2020 to just 2.1% in 2022, which equates to almost $6 billion. However, unlike AT&T, there is no clear-cut cause. According to the statement of cash flow, one reason was the tremendous amount they spent on inventories in 2020, presumably due to higher supply chain costs and interruptions. However, their inventories remain very low. They continue spending on spectrum licenses, with that now accounting for over 45% of assets. T-Mobile benefited from the additional consumer spending during COVID, but their equipment sales are essentially flat for the past 3 years. One reason for that may be that their COGS have doubled from almost from 11.8 billion to 21.5 billion. The largest single contributor to the decline in their net income is the growth of G&A expenses. Those have increased by over 52% in just 4 years. So to help these numbers and percentages into a format that's more intuitive, let's look at some comparative graphs. These are relative comparisons and not exact percentages. The first thing that stands out is the increase in AT&T's PP&E. The volatility, obviously, from the sale of Warner Brothers, but the trend of investment in PP&E over time is a good sign. So is the relative size of T-Mobile spectrum licenses, also increasing due to continued investment. Additionally, we can see that the dissimilarity between each company's share of goodwill demonstrates how T-Mobile's leadership has made better acquisition choices over the past few years. Relatively, the size of T-Mobile's operating expenses is noteworthy at almost 14%, but we don't have time to delve into that right now. Here, the drop in AT&T's equity is immediately apparent, but that is misleading. It is due to the sale of Warner Brothers and the issuance of stock in the new Discovery Warner Brothers company. AT&T shareholders received 2.4 shares in the new company for each share of AT&T. AT&T Corporate remains the largest stockholder with 51%. While AT&T is known for having a ton of debt, and we see that has only increased over the past few years, it is surprising to see that AT&T has just now reached approximately the same level of debt as T-Mobile. Both companies now hold about 31% of liabilities in long-term debt. In this slide, we can see the two companies are struggling with the same issues, but in different ways. They are both trying to grow revenue, but AT&T is doing it more through equipment sales, and T-Mobile is focusing on growing customer base. And here's a closer examination of the COGS. While there are minor differences, the main takeaway is that they're both spending approximately the same level of COGS at 42 to 45%, with AT&T holding the slight advantage. I'll now turn it over to Shri.
Let me take you all through the financial ratios for AT&T and T-Mobile over the last 2 years. First, let us look at the leverage ratios. When we look at the leverage ratios, we see that both the capital structure leverage and the debt to equity ratio for both AT&T and T-Mobile, we can see that for AT&T, the numbers are much higher than for T-Mobile in the last 2 years. This suggests that AT&T is more leveraged than T-Mobile. Now, talking about the solvency ratios, we can see that the current ratio for AT&T is much lower than for T-Mobile in the last 2 years. This means that AT&T has a lower ability to meet its short-term obligations than T-Mobile. The similar case for quick ratio. AT&T's quick ratio is much lower than for T-Mobile in the last 2 years, indicating that it does not meet its short-term obligation easily than T-Mobile does. When we look at the account payable turnover, we see that AT&T has a smaller number than T-Mobile does. This means that AT&T takes much longer to pay its supplier than T-Mobile. Let's move on to asset quality ratios and expense control ratios. We see that AT&T has a lower account receivables turnover than T-Mobile in the last 2 years. This means that AT&T takes much longer to collect its receivables from T-Mobile. When we come to the inventory turnover, we see that T-Mobile has a much higher number than AT&T does. This means that T-Mobile is able to use its inventory much better and quickly than AT&T does. Now, coming to expense control ratios, we see that the return on sales for AT&T is much lower than for T-Mobile. This indicates that in the last 2 years, AT&T has not been as profitable as T-Mobile has been. Finally, when we look at the overall performance ratios and other ratios, we see that for AT&T, when it comes to return on assets and return on equity, both these numbers for AT&T is much lower than for T-Mobile. This indicates that AT&T is not as efficient in using its assets or equity to generate profits as T-Mobile does. And when we see the earnings per share and price to earnings ratio, we see that AT&T does not do well as T-Mobile does. This indicates that AT&T is not as profitable for its shareholders, and that market is not as willing to pay for AT&T stock as it is for T-Mobile. In conclusion, the financial ratio suggests that T-Mobile is in a much better financial state than AT&T. T-Mobile has a lower debt load, a higher ability to meet its short-term obligations, and a higher profit margin. T-Mobile is also more efficient in using its assets and equities to generate more profits. Additionally, the market is more willing to pay for T-Mobile stock than it does for AT&T stock. In conclusion, I believe that T-Mobile is in a much better financial state than AT&T just based on the financial ratios.
Let us now look at the decision-making factors for investing in and lending to these two telecom giants. As we examine AT&T's Q2 2023 numbers, we notice an adjusted EPS increase of 5% from last quarter, but a decrease year on year. The strong 7.9% dividend yield really stands out, making it attractive for income investors. However, we also observe high leverage of 3.52, warranting caution. Though it has come down from the previous year, the DE ratio remains high at 2.5, revealing a need for prudent debt management. From a creditor perspective, the low quick ratio of 0.35 raises significant liquidity concerns. Combined with high leverage risk, AT&T's debt profile presents challenges. Moving to T-Mobile, we see a dynamic contrast. Their adjusted EPS may be below expectations, but an impressive 22% year-on-year increase reflects strong growth. Additionally, revenue growth at 2.6% year-on-year exceeds AT&T's numbers. Though the leverage remains high at 3.2, T-Mobile shows more conservative debt management with a DE ratio of 2.2 in Q2 2023. They also display improving liquidity, with the quick ratio moving up to 0.65, and an overall better solvency picture. Their lack of dividends might deter some income investors, but this is offset by the company's other positive growth factors. So, we've analyzed both giants in the telecom sector. Now let's formulate our strategy with our $150 million investment portfolio. For T-Mobile, we're investing $70 million eyeing growth and efficiency given the consistent double-digit increase in EPS and stock price surge year-on-year. We're also willing to lend up to $50 million for a 7-year term secured with debt agreements. The reasons? Improving liquidity, comparatively more stable debt position in spite of overall high leverage due to 5G expansion, and better solvency compared to AT&T. For AT&T, we are investing $30 million aiming for steady income thanks to its generous dividend yield and diversification. However, the high liquidity concerns and significant leverage risk prevent us from lending. Our $150 million allocation in telecom balances growth, income, and risk. It's an informed, strategic financial path. Thank you.